For the first time in the last 80 years, the US dollar, which once ruled the world, is facing its biggest threat. Right now, more than $7.5 trillion worth of US financial assets could soon be sold off by foreign governments. Countries like China, Russia, Brazil, and many others in Southeast Asia are no longer trusting the US dollar. Instead, they are starting to use their own money because they want control over their economies. They are not making speeches about it. They are taking action. This is not just another market dip or normal recession. In 2025, the US dollar has crashed harder than it has in years. The dollar index has dropped by 10% in the last 5 months, which brings it to levels we have not seen since the 2008 financial crisis. The Federal Reserve is currently holding interest rates steady, but it's almost certainly considering cuts to avoid a full-blown recession. However, these measures will only make things worse, and global investors are increasingly turning away from the dollar. And here's where things really start to change. Currencies in Southeast Asia are now going up in value. The Thai baht, the Indonesian rupiah, and the Singapore dollar have all gone up. That kind of growth hasn't happened since the early 2000s. These countries are making smart moves. They are trading in their own money, setting up new financial systems, and cutting their ties to the dollar. For decades, everyone believed the US dollar would always stay on top. But that idea is falling apart now, not with big announcements, but with quiet shifts in trade deals, real investments, and powerful economic decisions. And if things keep moving in this direction, it might not be BRICS that leads the charge. It could be the central banks of Southeast Asia, which are gaining strength and independence, that finally tip the balance. Before we go any further, hit that like button and subscribe if you want the truth behind the headlines. From 2023 to the first half of 2025, something happened that made many economists sit up and pay attention. China sold over $150 billion worth of United States government bonds. This was not a small adjustment or an attempt to play the markets for short-term gains. Instead, it appeared to be a planned and deliberate move, part of a larger strategy that has been quietly forming over the past few years. At first glance, some Western financial analysts dismissed this action as temporary or unimportant. However, when looking deeper at the trend, it becomes clear that China is not alone. More and more countries, especially members of the expanded BRICS Plus group, including the original 5 along with Iran, Saudi Arabia, Egypt, and the United Arab Emirates, have also started reducing their holdings of US government debt. This signals something bigger than just short-term financial reshuffling. It shows a worldwide loss of trust in the American financial system. For many years, the United States used its strong economy and control over global financial institutions to guide the economic decisions of other countries. Groups like the International Monetary Fund, IMF, and the World Bank gave loans to poorer countries, but these loans came with many conditions. Countries had to cut government spending, sell public companies, and open their markets to foreign businesses. These steps were said to help economies grow, but in the short term, they often caused pain. Public services were reduced, and local businesses struggled to compete with international companies. Over time, many countries, especially in Africa, Latin America, and parts of Asia, began to feel that relying on the dollar and Western financial systems was hurting them more than helping. In 2025, this frustration has led to real change. Today, more than 43% of African debt is now owed to private lenders in China instead of the IMF or World Bank. Senegal, for example, is working to raise more money through taxes so it won't need to borrow from abroad. Argentina is another example. Its new president, Javier Milei, has made big changes to the economy, cutting government spending and removing currency controls. These changes have helped lower inflation and attract foreign investors again. Many countries are now moving away from using the US dollar in trade. In 2025, many BRICS countries officially stopped using the dollar for trade and started using their own currencies instead. One example is trade between India and Indonesia, which is now done in local currencies instead of the US dollar. Brazil is also distancing itself from reliance on the US dollar. They have created tools like BRICS Pay to allow countries to trade with each other using local money. In Africa, A system called the Pan-African Payments and Settlement System, PAPSS, is helping countries trade with each other using their own currencies, not the dollar. Central banks, the institutions that manage money in each country, are also making changes. In 2025, more banks in Africa and Asia are adding Chinese money, the renminbi, to their currency reserves. This means they are slowly preparing for a future where the dollar is less important. A report from the Official Monetary and Financial Institutions Forum, OMFIF, said many central banks expect the dollar's role in global reserves to shrink over the next 10 years. This is why they are moving to gold and ditching the dollar. Trade around the world is also changing. The OECD, a group that tracks the global economy, said in 2025 that growth will slow down to just 2.9% this year and next. Countries are making new trade deals to reduce their risk. Some of these agreements use local currencies instead of the dollar. One example is the deal made between the European Union and Mercosur, which is a group of South American countries. This deal is designed to strengthen trade without relying so much on the dollar. But the most impressive rise against the dollar are the ASEAN currencies, which no one has paid attention to until recently. In April and May 2025, the US dollar lost ground across much of Southeast Asia, and that was a big win for the region. Currencies like the Singapore dollar, Thai baht, Malaysian ringgit, and others all got stronger, signaling a shift in investor confidence. Why did this happen? Experts point to several reasons. First, America's rising government debt made investors nervous. Second, inflation stayed low across Asia, making the region more stable. Third, countries like Malaysia and Indonesia were offering better interest rates. And finally, after Washington introduced new tariffs, investors started to lose trust in US trade policy. The currency moves were no small feat. In April alone, the US dollar fell nearly 3% against the Singapore dollar, ending at 1.31, and then dipped further in May to 1.28, its strongest level in over a decade. A similar pattern played out in Malaysia and Thailand, where the dollar dropped roughly 2.5% each month, ending May at 4.2 ringgit and 32.5 baht respectively. The Philippine peso followed suit, strengthening 2.5% in April and holding steady in May. Even Indonesia's rupiah, which often lags, showed momentum, with dollar falling more than 3% across the 2 months to 16,300 rupiah. So by the end of May, nearly every major ASEAN currency was not just stronger. It was climbing steadily. And this raises a key question. Is this simply a short-term reaction to US troubles? Or are we witnessing Southeast Asia quietly stepping into a more powerful economic role on the global stage? But this surge in currency strength isn't happening in isolation. It's directly tied to a shift in global trade, one accelerated by tariffs. The South Asian countries may have Trump's tariffs to thank. Because of these tariffs, trade between China and the US has dropped sharply in 2025. Companies around the world are now looking for new places to manufacture their goods where it's cheaper and easier to do business. As a result, countries like Vietnam, Malaysia, Indonesia, and Thailand have become new manufacturing centers. Large global companies, such as Apple and Intel in Vietnam, and HP and Dell in Malaysia, have invested a lot of money in building factories and expanding production in these countries. This increase in foreign investment has helped local economies grow faster. It also made their currencies stronger. At the same time, ASEAN countries are starting to trade more using their own currencies instead of the US dollar. This change helps them avoid currency risk and makes trade within the region cheaper and faster. To support this move, the countries also introduced a shared QR code payment system. This system allows people and businesses in different ASEAN countries to pay each other using their local currencies by simply scanning a code. It's already working in places like Singapore, Malaysia, Thailand, Indonesia, and the Philippines. So far, the results are clear. ASEAN is becoming more important in the global economy. The rise in local currency usage, stronger investment, and the shift of trade from the US and China to Southeast Asia are all signs that ASEAN is rising fast. Meanwhile, back in the US, the situation looks increasingly unstable. When Warren Buffett, one of the most trusted voices in finance, says the US dollar is going to hell, it causes waves in the financial world. Buffett points to three big problems: massive government debt, broken politics in Washington, and falling global trust in American leadership. These are not small issues. They shake the very foundation of why the dollar is seen as safe and reliable. US debt has exploded in recent years, and with both political parties fighting constantly, there's little hope of any serious reform. The federal government now owes more than $36 trillion, and it continues to borrow more every day. Foreign governments and investors are beginning to doubt whether the US can manage its finances responsibly. If that trust breaks, the world might start turning away from the dollar faster than anyone expects. As the US grapples with mounting fiscal challenges, global investors are reevaluating their positions. Major institutions are increasingly divesting from American assets, signaling a significant shift in global financial confidence. The Congressional Budget Office projects that recent tax legislation could add $2.4 trillion to the national debt by 2034. Such figures have raised alarms among investors, prompting a reevaluation of the US as a safe investment haven. In contrast, emerging markets, particularly in Southeast Asia, are attracting increased investment. Stable economic policies, favorable demographics, and technological advancements make these regions appealing alternatives for global capital. The shift away from US markets underscores a broader realignment in global finance. As traditional power centers face internal challenges, emerging economies are stepping into the spotlight, reshaping the investment landscape. If more countries stop using the dollar and selling American debt, the United States will find it harder to borrow money. That would mean higher interest rates, slower economic growth, and more difficulty funding government programs. The fall of the dollar opens new doors, but also unleashes global uncertainty. With over 12 cross-border currency corridors now in early development, the old system is breaking apart. The era of quiet de-dollarization is over. The real question now: can America adapt to a world where it no longer calls the shots? Or has it already passed the point of no return? For more analysis, subscribe to the channel and check out our other videos. Thanks for watching, and see you in the next one.